Hello, everyone. My name is Andreas. I am the head of product at Wildcat Protocol, and I'm going to talk about under-collateralized credit and why it is important and how we're addressing the overall solution or problem that we have. So just to quickly remind ourselves, what does it mean? Credit. We have traditional credit. We have over-collateralized credit. We have under-collateralized credit. In the traditional world, you go to a bank, you basically show them everything that you have, income statements, anything that you own, and then they type it in the computer and determined on specific factors. They either say, yeah, we're going to give you some money, or we're not going to give you some money. It's mostly determined on how much money can they get from you in future, or are you buying something and need the money for, and if you're not able to pay it back, can they liquidate it easily? And you have to pay high interest on it. Now, if you over-collateralize credit, and that's what we typically have in crypto, is you don't really have too much default risk, because anybody that wants to borrow money needs to basically also include more money into what he's actually borrowing. So the value behind that is a question mark. Huh? Typically what happens is people that have, for example, a huge amount of ETH but don't want to sell it, but they want to have more liquid or more stable tokens, they exchange it for DAI, and to get like 100 DAI, they have to put in $150 worth of ETH and then pay interest on it. And at some point of time, they can exchange the DAI again for the ETH that they have, ensuring that whoever gives them the DAI, they will never have the risk of basically losing what they give you, because it is over-collateralized in such a dimension that the price would need to drop 30, 40, 50% to result in a default here. And the under-collateralized aspect is something, it's not really new. We had a lot of problems in the past with under-collateralized credit that resulted in a lot of, collapses overall. The whole drama around FTX was also very related to under-collateralized credit. And it basically means that I borrow money, but I don't give you any collateral. The only thing that I provide to you is either a legal contract or trust that I will return the money. And, trust on blockchain is something that is a little bit tricky. But to bring you into the scope of why we need under-collateralized credit, I'm going to take the most easiest example and compare it with money and the value that we have in the traditional world. And if we want to, crypto being a competitor, showing you why we need under-collateralized credit. Now, what is money? There are a lot of definitions. Typically, regulators regulate what the definition of money is, up to the concept that, the term cryptocurrency is not a legal term. And if you talk to regulators, they say it's not cryptocurrency, but it's crypto asset, even though we defined the term cryptocurrency long before they actually know what it is. But this is a picture of the first thing that you see if you walk into the Central Bank Museum in Frankfurt. And I like the definition because it basically just defines in money is something that people trust in. And it needs to have specific characteristics. But overall, if I read that, that's one of the things that I say, yes, crypto could be this. And crypto is this in some scenarios. So we could compare crypto to money. And why shouldn't crypto be money? The way money is created nowadays is there are different types of money categories, M0, M1, M2, M3. I'm not going to go into detail with that. But the critical point that I'm making here is M0 is the only true money. It is hard cash in your pocket. It is anything that is a paper bill, and that is a coin. And this is money that is basically being issued by central banks. And all other value is derived by central bank money with specific multiplicators or just using that as collateral. And the overall factor then results in, M3 plus large deposits being 150 trillion US dollars overall. And if we compare this to what crypto's, value is, it's a small fraction. So if we say that crypto is going to be something that is supposed to be an alternative to traditional finance, or is at least supposed to play at the same level, there is, in terms of value, a pretty big gap. And even though I'm optimistic that crypto will increase in value, I don't think that we're going to fill the gap with just ETH going up, Bitcoin going up. I do think we need more tools in our toolbox. And then if you see what the overall credit market is within the world, the screenshots from Aave, stablecoins, etc., you need about 3 times the amount of collateral to get a credit of the value that you want to have. And this naturally then results in the problem that, in crypto, where in the financial world the graph goes up, in crypto the graph goes down, which results in us not being able to compete with traditional finance, because we don't have any multiplication factor in here. We cannot generate more value out of what we have based on credit. This can be good, this can be bad, depends on who you talk to. Understanding credit risk in DeFi and in the traditional world, already talked about it a little bit in the beginning, but what I want to basically say here is that we can use specific tools to guarantee transparency to ensure that even if we do issue under-collateralized credit, we can ensure that whoever we issue that credit to has the means to pay us back without necessary, showing into what exactly he has. And we can do this by using ZK Tech and TLS notaries, where we basically create systems where we ask specific questions on chain and we get the ZK proof for it that guarantees that there is still liquidity in the borrower side and they will not go into default within the next 5 or 6 minutes. The overall challenge is there are credit systems already on chain. Credora, for example, they do credit ratings on chain. I think they do it once a week. Like 1 time a week, rating somebody based on his assets is good, but we all know how fast crypto can move up and down. Therefore, we actually need to have like a just-in-time query or some way to, have live monitoring. And for this, we need to increase, the role of ZK Tech, allowing to ask specific questions. For example, does this borrower still have ownership over at least 80% of the assets that he has borrowed from us? And we can, create a system that then thinks back, yes, he has it, but we're not telling you where. We're also not telling you what he's using it for. And this gives me as a lender just the confidence, okay, in theory, he has enough money to be paid back, and I'm not scared that he, lost all the money, and at some point of time, I can withdraw my money back out of it, and he has the reserve to pay back. Now, we're not building this, we're building Wildcat Protocol, and we're building it because currently under-collateralized credit basically sucks on chain. There is no good solution for it. It is heavily driven on the lender side and not for the borrower side. And the overall transparency is generally very, very bad. And if you want to do under-collateralized credit, the alternatives are very limited. You can, of course, go to Aave, Compound, or somewhere else and generate your 5 to 6% yield on lending DAI in an over-collateralized manner. But in an under-collateralized manner, the borrower is able to use more money and generate a higher percent yield, where I'm not saying like 20, 25, 30% yield, because that's dangerous again, but it could be like 8, 9, 10, 11% yield. So the overall philosophy that we have is that if DeFi wants to be a counterpart to traditional financial world, we need to use similar tools that we have in the traditional financial world, which, for example, is fractional reserve banking. And this really depends on what type of person you are and what you see where crypto is leading. But if you're saying that crypto is supposed to be an alternative to the traditional financial world, we need these kinds of tools. If you say crypto is a niche product and we never use it for real-time payments on a global scale, then maybe we shouldn't use fractional reserve. But if we really want to compete with the traditional financial world, we need to use traditional financial instruments in some way or methods to generate the value that we currently don't have on chain. And therefore, our goal is to create a protocol that is an alternative to banks that issue credit or companies that do peer-to-peer credit in some way. Just being able to capture any credit agreement on chain. And this could be over-collateralized credit, this could be under-collateralized credit, this could be non-collateralized credit. Currently, we are focusing on non-collateralized credit and under-collateralized credit. For explaining the overall difference and why we are building something that we think other people are not building, the overall market is dictated and determined by lender-focused people that heavily focus on retail. So anything that you can see out there that is related to credit on-chain is typically a product where the protocol says, hey, if you have too much money, give it to us. We'll give you an APY on it, and we'll find the right person to give it to, and we'll reduce the overall default risk. And we're switching it. We're saying we're not targeting lenders. We are targeting the borrower side. And we're allowing the borrower basically to dictate their own terms of how they want to lend money. So any borrower that joins our platform can create the markets, and they define what type of APR am I giving, what type of token do I want, what time of repayment cycle do I want to have. And this basically gives the borrower the option to create their own offerings and then to attract lenders. The product that we have is not a retail product, so we're not looking for the typical retail person to invest or to give like their 10, 100, 1,000 USDC in the platform. We're more looking for bigger projects, market maker, family offices to onboard and go to our platform. And the current scope is that we're live. We've been live for about 8 months. We have 30 million in GVL. And we're launching V2 soon. And V2 will concentrate on numeration markets or minimum deposits that the borrower basically can freely change or determine what exactly the parameters are going to be. KYC, really important. The potential here is, again, talking about, like, for example, the bond market, which is like 130 trillion overall. Very interesting in our opinion, and it is a use case that, even though it has a big potential to elevate crypto to the next level, it is something that is not being addressed enough. And that's why we're trying to do this. Small team, very few people. And if you have any questions or want to reach out, that's my email address. Or if you have questions now, go ahead.
Oh, it's also on stream? Okay, hi. So what's the main guarantee for like the borrower not to default on obligations? Is ZK or off-chain contracts? What's the main source of?
The main source of why the borrower would not go into default, is that the question?
Like that KYC.
It's the lender can decide if they want to give the borrower the money. And the borrower basically gives the terms. Now, one of the terms could be, I want to sign an MLA with you, so a master loan agreement that basically gives the lender the legal entity name and anything that is related to the credit that the lender gives to the borrower. And that is the risk that you still take. You basically give money to somebody that you screen yourself and you know. So like one of our users is Wintermute, for example. So like anybody in the ecosystem that would want to lend money to Wintermute would research Wintermute, say, okay, they're a big market player and they are able to, give back my money when I need my money. Or if they default, then I can still sue them because they're a big company that have a legal entity. And that is the risk potential that you have.
Oh,
So we're not mitigating it through the collateralization ratio, but we're mitigating it through the overall transparency that you have on chain. And then in future, we want to, of course, partner with other projects that allows for a better credit scoring or borrower score. And one of the examples here is like doing credit risk analysis through ZK Tech. But we're not doing that. We're looking for partners that would be able to do this. So Accountable, for example, is one player in the ecosystem that uses this kind of technology to determine credit risk for somebody that borrows money.
Okay, but it's more like using the traditional finance model to...
It is using traditional financial models, also using traditional financial contracts, or contracts, not smart contracts, but actual paper, to guarantee that if somebody runs away with my money, I can sue them. But again, I have the choice to give them the money. And this is then dependent on what my credit risk and my appetite here is.
Okay, one more question.
Yeah, cool.
What's the main benefit of your protocol when just fighting the actors on the street? So discovery or some other?
Discovery is definitely one point. Like not a lot of people know that, if they are a company, they could lend to these players that we're targeting. But it's also the transparency. So you can see the markets that the borrowers create. You can see how much money is going in. You can see how much money is going out. You can see if they're actually paying back the APY. So all of this gives higher transparency to what the borrower is actually doing with the money. Now, in combination with then on-chain KYC integrations, for example, a lender could choose to give a borrower money without disclosing his information to the borrower, but just providing, the proof that he is fitting into the parameters that the borrower is looking for. For this, for example, we're using Keyring. And we're using Keyring as a partner here, where they basically allow the borrowers to create specific KYC parameters, and then the lenders provide all of the criteria to a KYC proof check, and then the borrower only gets the, yes, he fulfills your criteria, but they don't get the information of who the lender actually is.
So is it important for the borrower to understand who the lender actually is?
For the good point, because the borrower basically has the money, he doesn't actually care about who the lender is, But if, for example, you're dealing with somebody that gives you money from the United States, then you may not want to have that money. So there are specific reasons why you would say, I don't really care about where the money comes from, but I want to be sure that it's, for example, not coming from the United States, because I don't want to deal with the SEC or whatever. And we had cases just 3 or 4 weeks where the SEC actually went and took people in front of court that were collecting money to from lenders to borrowers, and they were basically said, yeah, you're issuing a security which you're not allowed to do. And so that gives also the security.
Hi. First of all, I really love your cup.
Thank you. They don't produce them anymore. I'm like really holding on to it.
Yeah, I was about to come to you after and ask like we're together. Anyway, question more philosophical. So like you mentioned things like fraction reserve banking and other things like that, and under-collateralized and everything. Like philosophically, like it's kind of maybe against the vision of like a crypto ecosystem. Like this is exactly what we want not to have. we don't want to create, again, worthless paper money. We don't want to create economy of debt, and so on and so forth. Like, yeah, so like more philosophically, do you think that projects like that, like what are your arguments that these kind of projects will actually benefit the ecosystem, not like decrease the trust or decrease these values that like drive this entire thing?
The philosophy of what crypto is and what it's supposed to do and what we're supposed to do with it has changed over the years. But if you like look back on like 2009, 2010, you know, the original times, yes, I do agree with you in some sense. The difference I think now is that we can use the tools that we've created and we can build something better in comparison to traditional financial world without necessarily saying no to all of the components that the traditional financial world has to offer for us. Because we can build it in a way that it increases overall transparency. And transparency is the key in this scenario where you basically still allow for, you know, the concept of, you know, fractional reserve banking, but you actually can see on chain what the movement of the money is. You can actually see who the players behind it is, and you can actually see when problems arise and not read it in your newspaper in the next day when the next bank collapsed because, you know, they didn't let anybody look in their bank books or bank statements. It's the same question about, you know, self-custody, non-self-custody, etc. In theory, nobody should use a custody service because that's, you know, not your keys, not your money. Yeah, but the truth is, mass adoption without it won't happen. Yeah, people don't want to deal with private keys on a large scale. So we have to find a balance, in my opinion. And as long as we're increasing the overall use case of the old traditional financial world and making it better, and I believe that this is making it better, I think it's a step in the right direction.
I'm gonna do one and one as the last one.
So the approach is a hybrid between traditional finance and blockchain. And I was wondering if, in your opinion, this also open up the possibility for new malicious attacks or malicious action that would not be possible in TradFi.
Yeah, I mean the like we have a very hands-off philosophy of the deployment. Like we deploy, we cannot touch it afterwards. We cannot change it. We don't have control. We don't have any backdoors. So yes, in theory, if, you know, our code is wrong and it opens up the risk of, you know, somebody exploiting what we've developed, then that would be bad. But that's why we're doing audits and making sure that people are educated on how to use what we are deploying. In terms of like the pure concept of, you know, money in, money out, and if that creates new attack vectors that are not within the current traditional world, I would say probably not. The only additional risk that you might have, but that's like an ecosystem problem. Like you have the overall problem of as soon as we, for example, introduce markets that are connected with oracles, you have oracle risk. Yeah? So that's an ecosystem problem. That's not specific to us then. But other than that, no. I can think about it a little more and think after I'm done with the questions.
Oh, 1 second. Okay. I have a question. Afraid that these types qualified as securities.
Good question. And as I mentioned that in the past 2 or 3 weeks, we had the incidents that similar stuff has been classified as potential security. We, as Wildcat, we're not participating in the deal flow. We're just basically providing the UI and the front end for the borrower and the lender to come to an agreement. And we also don't target the lender we only target the borrower, and we make it easier for the lender to contact the borrower, but also to like find markets that the borrower has to join the borrower. So in our case, for me personally, I don't think that Wildcat has a high threat of, you know, being sued for something like that. Now on the borrower side, that could be different, and the borrower will definitely have their own legal team that looks into it, and, you know, thinks about what this has for implicit reasons of being a security or not having security. We actually did a change in V2, which allows for the borrower to determine if a lender puts money into the market that the borrower creates, they get market tokens. And this could be, in some scenarios, some people would say, since there's a new asset being created, this could be not good for us. So we have the option to like turn that on and turn it off, so that the borrower can define the market tokens can be created, but they're not transferable again. They're just there for bookkeeping purposes. So but maybe, but I can't give you a clear answer, yes or no, to that question. It depends on the market, depends on which country you're in. Yeah, thank you. Yeah, definitely. Yeah.
Yeah, let's end with wish you good luck. It's a good.
And then okay.
Thank you, Andreas.